Hello, this presentation is based on the Toddler Treasures Incorporated case study, presented by Shelley, Eric, and Renee. Here is the overview of what we will cover in the presentation. We will begin by introducing Toddler Treasures. Then we'll bring insight on what the problem is for the company. Next, we will discuss factors for making company changes. And lastly, we will conclude by analyzing the purchasing decision. Toddler Treasures basically began as a sewing circle for a group of locals in the state of Iowa. As the concept of Toddler Treasures popularized within the group, a select few of them became serious about making this idea into a real business. So some of those members developed an actual business and made their focus on producing and selling products targeted for children. When the startup decided on their first product, they decided on introducing a brightly colored blanket that would best fit children under the age of 5. Chief Financial Officer David Reed took this business concept and he decided that adopting a standard costing system would best fit the new business. The company CFO, David Reed, has decided to implement a standard costing system. Reed is wanting a system that will be comprehensive in planning and controlling to better organize the company's accounting and budgeting areas. He has an initial standard manufacturing cost per blanket, which is based on a conservative and realistic expectation. This would be a contributor to the adoption of a standard costing system because to gain the full benefit of standard costs, the system must be based on expectations that are realistic. Also, the CFO tells us that Toddler Treasures does not have sufficient cash, which becomes another contributor to adopting the standard costing system. The company can take advantage of creating these standard predetermined costs from their normal monthly sales and production. Because the company does not have enough cash, they are benefiting from having almost no work in process or finished goods inventory. This actually helps them to secure their budgeting because the process entails a short production time. So having almost no work in process and finished goods inventory just becomes really unimportant. Additionally, the CFO has determined the standard cost of the company's blanket to be $74, which contributes to the standard cost because the system follows a flexible budget that is based on a standard unit cost, which is helping the CFO and managers feel secure about pricing their products fairly and just making sure the company is selling at prices that are exceeding the full cost of each unit. Now that we have introduced the company and have discussed their decision on adopting a standard costing system, we will now identify the actual problem of the company and provide calculations on several areas to further understand the situation. No initial problem was being experienced for Toddler Treasures, as their forecasts were very similar to the actual results during the first months of startup. So even though the company was reaching expected sales and production, the product manager, Gloria Cantonese, still felt the need to reach out for an opportunity by immediately switching suppliers. The main problem in switching suppliers is that the new material is actually more expensive than the current material being used. Naturally, if the material is higher, a company normally increases their price, but Toddler Treasures decided that they just didn't feel comfortable increasing their price because the blanket was already priced at $100. To further evaluate Cantonese's decision, price and quantity variances will be analyzed for material and labor while examining overhead variances.
Next, we're going to be covering the material purchase price variance. And in this formula, we will take the actual quantity purchased times the actual unit cost minus the actual quantity purchased times the standard unit cost. So in other words, we take the 220,000 square yards that are purchased times the new price of $8.25 minus 220,000 square yards times the old price of $8, and that gives you a total of $55,000, and that is a loss to the business. Next, we're going to talk about material quantity use price variance. So for this formula, we're going to take the actual quantity times the actual unit cost of $8 minus the standard quantity times the actual unit cost of $8. So in other words, 110,000 square yards at $8 a square yard, we're able to make 20,000 blankets at 6 square yards per blanket at $8 per square yard. That gave you a $80,000 gain. So something happened here in the process, whether it's a better quality of material that can stretch more, maybe you're not having to throw away as much product, whatever the cost may be, it gave the business an $80,000 gain. So if Taller Treasures Incorporated decides to stay with the new material, the company will be losing $55,000 a month because of those extra 25 cents that are being charged now. So instead of $8, they're going to be paying $8.25 for the material. However, if the business keeps their quantity usage lower than the projected usage, like the month of May, Taller Treasures will be receiving an $80,000 savings. So essentially, Taller Treasures is making more with less material. The two situations end up giving Taller Treasures an overall increased revenue of $25,000 a month, which will be an equivalent of $300,000 in one calendar year, should Taller Treasures keep producing the same way. Now we're going to be talking about direct labor price variance. We will take the actual quantity of 9,000 hours times the actual unit cost of $16.90 minus actual quantity of 9,000 hours times the standard unit cost of 16 hours. So in other words, the company had to pay overtime, and because of that, the actual unit cost of per hour ended up being $16.90, where the standard hour is actually paid at $16. So this gave the company an $8,100 loss. To calculate for direct labor quantity variance, we will take the actual quantity of 9,000 hours times the actual unit cost of $16 per hour minus the standard quantity of 20,000 blankets times the actual unit cost of $16 per hour. However, the blankets are produced at 2 blankets an hour, so that's 30 minutes. We cut that down in half, so it's about $8 per blanket. So that would be 9,000 hours times $16 minus 10,000 hours times $16. That will give you a $16,000 gain. In summary, the direct labor cost, the price variance in direct labor for May is an $8,100 loss, while the quantity or efficiency in labor is a $16,000 gain. Both combined will give the business a $7,900 reduction in direct labor costs for the month of May.
Labor variances take into account the actual cost for a company versus the budgeted costs. For the month of May, the overhead variances for Toddler Treasures were favorable. The variable overhead number was found to be 10,000 favorable, and the fixed overhead number was found to be 1,000 favorable. This means that the company spent less than they had anticipated in the month of May.
We have just finished reviewing problem identification along with calculations for further evaluation, and now we will review some factors that enhance the company's decision for change. Gloria Catanese, the company's product manager, decided to change their fabric to a more expensive blanket material in hopes to improve the toddler treasure's profitability. Gloria found an opportunity with a new supplier that would provide the chance for toddler treasures to grow when she saw value in a new and improved fabric material. The obvious decision to switch materials is from gaining competitive advantage, since this new product is unique, high in quality, shows improvement in texture and appearance, along with being durable and long life compared to the company's current product. Providing a higher quality material would have customers appreciate and value toddler treasures even more because the price would remain the same at $100 while delivering a better product. The likelihood of having increased sales goes up along with higher chances of gaining customer loyalty. This becomes important for toddler treasures because developing a strong relationship with customers becomes crucial, especially when starting a new business venture that is trying to establish themselves in the market. After identifying the business reasons for switching to an expensive material, we will now analyze the purchasing decision.
Analysis of the purchasing decision for the month of May. The manager indeed did make a good purchasing decision in the month of May. The actual costs were found to be $69.49 per item. This is less than the $74 estimated by the company. The standard costing method below was used to evaluate this decision. As you can see, we reached a result of $69.49 to manufacture, which is indeed again less than the $74 Toddler Treasures had budgeted.
This completes our presentation. Thank you so much for watching.